Subir Gokarn, Director Research with Brookings India and former Deputy Governor of Reserve Bank of India, joins us live from New Delhi. Mr. Gokarn, good morning. Thank you for joining us. The US debt ceiling has been extended, but no one is, celebrating. Financial markets clearly are of the view that what US lawmakers have done is that they've simply kicked the can down the road, and debt ceiling concerns will surface up once again in the first half of next calendar year.
Yeah, I think this was always the most likely outcome, a compromise which would buy time, giving the two sides a few more months to reach some sort of a robust settlement. Now, we don't know whether that will happen, but as we go into the early part of next year, I would expect that if a compromise hasn't been reached, a similar arrangement will be made, which is let's buy another few months. But I think what we have to be cautious about is that as we move closer to our elections, our room for policy maneuver is going to also reduce, because naturally the government is going to be that much more constrained in terms of what it can do. So February is not such a good time for a situation to precipitate. I don't expect it to. I expect that, again, the most likely outcome is a further postponement. I hope that a resolution is reached between now and then, but if not, a further postponement. In the meantime, I think to some extent our vulnerability is starting to move down. The most important indication of that is the trend in the current account deficit. The expectation is that this will move sharply down over the course of the next few quarters for a variety of reasons. The fundamental issues haven't been resolved, but at least the lower rupee and so on are helping to narrow that gap. So that is going to put us in a slightly better situation if and when the next shock comes.
Mr. Gokarn, the other, of course, talking point and rather, something pretty crucial has been the quantitative easing. What is your own view on when we are going to see the QE tapering? Do you think the tapering will start now only during the second quarter of 2014?
I think what has happened now is, firstly, of course, the nomination of Dr. Yellen has eased some concerns about a very hawkish stance being taken by the Fed. But more so, I think apart from that, the timing of tapering and the perception of its necessity is also being shaped by what's happening on the fiscal front. Because if there is a risk, as we've seen 17 days of shutdown. This has obviously had some macroeconomic impact. It may not be very significant, but it has had an impact. People have lost incomes, businesses have suffered a loss of revenues and so on. Now, if this is going to be a persistent phenomenon, that every few months, at least over the next couple of quarters, there is a risk that there will be a macroeconomic shock of this kind, then I think the pressure to taper also is going to be reduced. So I see the two as now having become interlinked. The prospect of tapering is really going to be shaped by how the fiscal situation is evolving. So if we do have a resolution on the debt and budget by early next year, which is the schedule that we have now, then I think we could expect to see tapering coming into play sometime after that. If we don't have a resolution, if we're moving, quarter to quarter on the U.S. fiscal situation, tapering, I think, will have to be, if not taken off the table, certainly rethought in terms of timing and pace.
Mr. Gokarn, whereas globally things are looking okay, tapering has been delayed, rupee has stabilized, back home inflation is a big problem. Food inflation is once again reaching alarm levels, and this is happening despite a good monsoon. So I wonder what the governor is thinking.
Well, I can't speculate on what the governor is thinking, but, food inflation is not a recent phenomenon. It's been with us for the last 5 or 6 years. It's been persistent, it's been stubborn, and it's been very, very high. Now, what's been happening the last few months, is that the drivers of food inflation, among the drivers of food inflation, cereals have made a comeback. Cereals were not such important drivers for quite some time. It was proteins and vegetables that were providing far greater momentum. But in the last 6 months or so, rice in particular has come back into play, and but the others are fading somewhat. Of course, this time we had the onion shock, which was, in the wholesale index, onion prices rose by 320% plus year on year. That's not going to stay. That's going to come down. But even then, even if food inflation is not 18% every month, if it's around 10% or more, I think it significantly reduces the space available for monetary action that will be more supportive of growth. I think there's just no way that you can allow food inflation to remain this high, and by ignoring it, by simply saying, look, we'll focus on other things, we can't do anything about it. So it does constrain the space quite significantly.
So given the central bank's focus and attention towards inflation, do you think one should brace ourselves for a rate hike come the end of the month, or do you think maybe not this time, but definitely the interest rate trajectory is going to be on the higher end?
I think the signals coming from the bank now are clearly consistent with the inflation-oriented signals coming earlier, which is that even if there is room to cut, which was the case before all of this rupee turbulence and the resurgence of inflation, even if there was space to cut, there was very limited space to cut. Now, I think that story has changed somewhat, because we moved from room to cut now to a question of whether to stay where we are or to hike rates. So it's really a choice now between these two options, given the return of momentum in inflation. Now, to the extent that core inflation, however you want to measure it, but if you say broadly manufactured goods inflation is around 2% or less, clearly that is suggesting the complete absence of any pressures from the demand side. And there is obviously idle capacity in industry. There is hardly any growth there. We saw 1% or less than 1% in the IIP for August. So industry is not growing. Pricing power is non-existent. And what's happening then is the supply side forces, food in particular, but also energy to some extent, are just squeezing business. So that's the balancing act that has to be done. Now, the dilemma is always very acute when growth is slowing and inflation is rising, because it really puts you on the spot. It really almost ties you into either raising rates, because inflation is a primary objective, or not doing anything, which doesn't really help growth. So I think that is the squeeze that monetary policy has been facing for quite some time and continues to face.
So which way is Dr. Rajan going to tilt? Do you think it's going to be a status quo policy, or will we see a rate hike this time?
I wouldn't want to predict the policy.
Okay, fair point. Would you then agree with IMF's India growth forecast of 3.8%? And do you think India's potential growth has been severely challenged, and it will be rather difficult to achieve 8% growth for the several years to come?
This term potential growth has many connotations. Some people view it as an aspirational number. Some people view it as a technical, and when we use it in the policy context, it's a technical concept, which basically means utilizing whatever capacity the economy has fully, so that there's no slack. Now, that number, many people put it in current conditions somewhere between 6 and 7. If you're slightly optimistic about it, you say 7. If you're pessimistic, you'd say 6. But let's say somewhere between 6 and 7, which means at this point we're clearly below potential, and there is some natural sort of recovery that will happen, which will take it back up to somewhere close to that. But at the same time, we can't ignore the impact of inflation on policy, on monetary policy in particular, interest rates not coming down as a result, and that itself starting to feed into the strength of the recovery. So there are two aspects that I want to emphasize. One is the short-term recovery opportunity, which may happen partly because of export growth. I mean, for example, with the rupee where it is, and the US showing some signs of recovery. Now we put the whole debt ceiling and so on behind us, at least for some time. So the natural recovery in the US, the already occurring recovery, will start to regain its momentum. So export opportunities, I think, are quite significant. Notwithstanding what you've been saying about the IT sector, I don't know that that doesn't square, but that's a 2-day phenomenon. So let's not get too carried away with that. Agriculture. Yes, prices are going up, but let's not forget the monsoon was good, and we should see some buoyancy in the agricultural, in the rural economy as a result of this. So there are some signs of recovery, some signs that that the economy will get back to somewhere above where it is today. But when you look at the longer term, I think the key issue that we've got to focus on now, and we're really, I think, putting ourselves at risk, is infrastructure. Because the only way we're going to get back to 8% is by making massive investments in infrastructure, which we plan to do at the beginning of the 12th plan, 2012 to 2017. But when we look at what's going on in infrastructure, we find that most of the companies that are implementing infrastructure projects are actually financially quite distressed. So we have to ask the question, where is the money that is going to build infrastructure going to come from? Because these companies, to me, don't look like they're in a condition to raise any more money. They're not financially healthy enough to do that. And the government is squeezed by its fiscal situation. So where is the money that we need to put into infrastructure going to come from? And if we can't get that money and we can't get these projects going, then I think 8% really becomes inconceivable. So we've got to be worried about the conditions that we need to have in place to take us from the current sort of cyclical recovery to a higher trajectory, a higher trend. And I think that there is a challenge there.
Mr. Gokarn, really appreciate you joining us today on ET Now. Always good chatting with you.